Silver has destroyed everything we thought we knew about the precious metals market. The entire architecture of suppression, the paper market control system, is in catastrophic failure, and the institutions know it. The immediate, verifiable proof of this institutional terror came just this weekend. Shanghai drained the silver vaults, and the first reflex was panic. The Shanghai Futures Exchange, SHFE, just pulled the emergency brake, hiking margins to unprecedented levels. This rote script will explain why this desperate attempt to stop silver will fail, and how its failure will fundamentally reshape the market over the next 15 minutes. First, let's establish the scale of the shock. Silver has not just appreciated, it has obliterated the 40-year historical nominal high set in 1980 at roughly $49. We are currently trading in the mid-$60 range, hitting an historical intraday high of $64.65 year-to-date 2025. Silver is up over 115%, a true moonshot vastly outperforming gold, which is up around 60%. This massive divergence confirms the revaluation is not merely a hedge against inflation, it's a structural break. The gold-to-silver ratio, the traditional measure of their relative values, has collapsed from over 90 to approximately 67, signaling a generational repricing of the white metal. This brings us to the ultimate signal of panic. Shanghai. The Shanghai Futures Exchange announced an emergency increase in margin requirements for their core silver futures contract to a staggering 17% for speculators. To understand the gravity of this, normal margin requirements hover between 5 and 10%. The SHFE was already operating at an extraordinarily high 16% before this emergency hike. Aggressive moves like this, enacted outside regular trading hours, mean the exchange is genuinely terrified. They fear volatility, they fear counterparty risk, and above all, they fear the loss of control resulting from an uncontrollable flood of physical delivery demands. We must understand the core conflict: paper versus physical. The COMEX in New York operates the paper market. It is a casino focused on speculation, high leverage, paper bets, and cash settlement. It is fundamentally disconnected from physical reality. The SHFE, however, represents the physical market, the factory floor. Its participants, namely vast Chinese industrial companies, use these contracts to secure real metal for actual production lines. They need the silver now. The engine driving this crisis is China's irrepressible industrial demand. China is the undisputed global champion in silver consumption. Look at the key sectors. They are deploying over 200 gigawatt of solar panels in 2025 alone, demanding thousands of tons of metal. Their EV production uses significantly more silver, 25 to 50 grams per vehicle, than traditional cars. The simple fact is that silver is irreplaceable in most of these high-tech green energy applications due to its peerless electrical conductivity. This demand is urgent, non-negotiable, and cannot be postponed. This is where the exchange's manipulation strategy fails. The exchange's playbook is clear: increase margins to force the selling of long positions, flood the market with paper supply, and thus crush the price. But there is one insurmountable problem: you cannot print physical silver bars. The industrial demand is based on physics and assembly lines, not on bureaucratic exchange rules. Every single time the exchanges try to smash the price via paper, physical buyers, especially in the East CIE, as an absolute fire sale and accelerate their buying, increasing the strain on the already depleted physical stock. The evidence is structural. The global silver market is projected for its fifth consecutive year of deficit in 2025. FAVA forecast shortage of 117 million ounces. Industrial fabrication demand hit a record 680.5 million ounces in 2024 and is expected to soar past 700 million ounces this year. Mining production is stagnant, yet industrial necessity is accelerating. We need over 3,600 tons of silver that the Earth simply cannot produce right now. What comes next? Short term, expect extreme volatility, more margin hikes, and trading halts. Every single intervention is an admission of weakness and loss of control. Medium term, expect continued and escalating physical premiums, widening the gap between the COMEX paper price and the actual street price for physical metal in hand. We will also see serious delivery issues if contract holders demand physical settlement. Long-term prices are headed into true discovery territory: $75, $100, and above. Basic economics dictates that the price must rise until demand is destroyed or new supply is incentivized. The panic in Shanghai is definitive proof that the decades-old control mechanism is fundamentally breaking. The authorities cannot stop this revaluation. The industrial demand is implacable, and the deficit is structural. You cannot fight physics with paper. The physical reality of supply and demand is finally crushing decades of paper market suppression. Silver has not merely risen. It has fundamentally destroyed the decades-old architecture of the precious metals market, signaling a complete system failure. This market move is what forced the global central banks and exchanges into their current state of panic. Culminating in Shanghai pulling the emergency brake, we must first grasp the sheer scale of the price annihilation to understand the desperation of the regulatory response. The price of silver has not just surpassed but obliterated the 40-year high established during the Hunt brothers era of 1,980, which hovered near $49 today. Silver is trading robustly in the $61 to $64 range. Having touched an intraday historical maximum of $64.65, this is not a normal commodity bull market. Year-to-date in 2025, silver is up more than 115%, a true moonshot, massively outperforming gold, which has seen impressive but comparatively modest gains of about 60%. Crucially, the gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has plummeted from over 90 down to about 67. This rapid collapse is the most visceral signal that a historic, massive revaluation of silver relative to gold is currently underway. This explosive price action is what triggered the single biggest admission of institutional fear: the emergency signal from Shanghai. Over the weekend, in an extraordinary move conducted outside of normal trading hours, the Shanghai Futures Exchange, the SHFE, drastically increased margin requirements for the primary silver futures contract to a staggering 17% for speculators. To put this in context, normal margin requirements across most exchanges hover around 5% to 10%. The SHFE was already operating at an unusually elevated level of 16% just prior to this announcement. An aggressive out-of-cycle margin hike like this is an unambiguous institutional scream of terror. It means the exchange is genuinely afraid of the volatility and the escalating counterparty risk, fearing a total loss of control over the derivative market and, most critically, fearing an overwhelming accumulation of physical delivery requests. This brings us to the fundamental conflict that Shanghai is fighting: the divide between the paper market and the physical market. On one side, we have the COMEX in New York, the paper market. This is the casino, dominated by speculation, high leverage, paper bets, and ultimately cash settlement. It is fundamentally divorced from physical reality. On the other side is the SHFE in Shanghai, which represents the physical market, the factory floor. The companies trading here are not merely speculating. They are securing real, physical metal right now for concrete industrial production. They need the metal today, not a promise for tomorrow. And it is this insatiable industrial demand, centered in China, that is crushing the old paper mechanisms. The engine behind this unprecedented price surge is centered squarely in Beijing. China is the undisputed global champion in silver consumption, and they are consuming at an historic pace. This isn't discretionary buying. This is essential, mission-critical industrial fabrication. We are talking about two key sectors that demand thousands of tons of silver immediately: the solar revolution and the electric vehicle transition. In 2025, China is projected to deploy over 200 gigawatts of solar capacity, requiring vast quantities of silver paste. Simultaneously, the manufacturing of electric vehicles (EVs) uses significantly more silver, between 25 and 50 grams per vehicle, than traditional automobiles. Why the urgency? Because silver is fundamentally irreplaceable in these high-tech applications due to its unmatched electrical conductivity. This industrial demand is urgent, non-negotiable, and cannot be deferred simply because the Shanghai Futures Exchange doesn't like the price. This brings us to the core analysis of failure: the end of paper manipulation. The typical playbook for any exchange when prices run hot is to increase margin requirements to astronomical levels. The goal is simple: force speculators the longs out of their positions via margin calls, resulting in a sudden, forced liquidation of paper contracts. This floods the market with paper supply, theoretically crushing the price back down. But this time, it won't work. The insurmountable problem remains: you cannot print physical silver bars. The actual demand is tethered to physical production lines and national economic goals, not to bureaucratic rule changes on a trading floor. The attempt to crush the price via paper creates a destructive feedback loop, a vicious cycle for the exchanges. Every time the paper market attempts to smash the price, the physical buyers in Asia and around the globe view the drop as an historic bargain and accelerate their physical purchases, removing more metal from the PEX system and increasing the structural pressure on the already dwindling inventory. This pressure isn't cyclical, it is structural. We are not experiencing a mere short-term shortage. We are dealing with a chronic, unfixable deficit. The global silver market is forecast to record its fifth consecutive year of deficit in 2025, projecting a scarcity of approximately 117 million ounces. This structural imbalance is driven by record-shattering consumption. Industrial fabrication hit a record 680.5 million ounces in 2024, and is projected to surge past 700 million ounces in 2025. Meanwhile, global mining production remains effectively stagnant. The equation is brutally simple: industrial necessity is accelerating, and supply cannot keep pace. The market needs over 3,600 metric tons of silver that it simply cannot produce. Regardless of how high Shanghai raises its margins, silver has just annihilated everything we thought we knew about the precious metals market. The entire system is in failure. The central banks and exchanges are in full panic mode, and we have definitive proof. Shanghai just pulled the emergency brake on the weekend, hiking margins to unprecedented levels. Our objective here is to explain why this desperate, heavy-handed attempt to stop silver will fail utterly, and how that failure is going to fundamentally reshape this market over the next 15 minutes. Now, full disclaimer, this is an analysis of market structure, not personal financial advice. The scale of the move is breathtaking. Silver has completely obliterated the 40-year historical record. The high watermark set back in 1980, at roughly $49 today, silver is trading aggressively in the $61 to $64 range, hitting a historical intraday high of $64.65. This metal is not just performing well, it is experiencing a true moonshot, up more than 115% year-to-date in 2025, utterly eclipsing gold, which is up a respectable but far smaller 60%. Crucially, the gold-silver ratio has collapsed, plunging from over 90 down to about 67, signaling a massive structural revaluation of silver relative to gold. And this is where Shanghai makes its move, giving us the clearest signal of institutional terror possible. The Shanghai Futures Exchange, or SHFE, dramatically increased margin requirements for the main silver futures contract to a shocking 17% for speculators. In an emergency weekend announcement, normal margin requirements typically hover between 5 and 10%. SHFE was already operating at an extraordinarily high 16% before this latest spike. This leads us to the fundamental conflict, paper versus physical. On one side, you have the COMEX in New York, which functions primarily as the paper market, a sprawling casino of speculation, leverage, paper bets, and cash settlement. It is completely distanced from physical reality. On the other side, you have the SHFE in Shanghai, the physical market, dominated by Chinese industrial entities securing real metal for production. They need silver now, not a promise of future cash. Look at the key sectors. Solar panel deployment is surging past 200 gigawatts GW in 2025, requiring thousands of metric tons of silver. Electric vehicles, EVs, use significantly more silver, 25 to 50 grams per EV, than traditional combustion cars. Silver is technologically irreplaceable in most of these high-tech applications because of its unmatched electrical conductivity. This industrial demand is urgent and cannot be delayed by bureaucratic maneuvers. The exchange playbook is clear. By hiking margins, they aim to force the liquidation of long paper positions, flooding the market with paper supply to artificially crush the price. But there is one simple, incontestable problem. You cannot print physical silver bars. Industrial demand is real, based on factory output and supply chain deadlines, not on the paper rules of an exchange. This creates a vicious cycle. Every single time the exchanges attempt to smash the price via paper, physical buyers view the resulting dip as a massive bargain and simply accelerate their physical purchases, putting even greater immediate pressure on the physical stock. This pressure isn't cyclical, it is structural. We are not experiencing a mere short-term shortage. We are dealing with a chronic, unfixable deficit. The global silver market is forecast to record its fifth consecutive year of deficit in 2025, projecting a scarcity of approximately 117 million ounces. This structural imbalance is driven by record-shattering consumption. Industrial fabrication hit a record 680.5 million ounces in 2024, and is projected to surge past 700 million ounces in 2025. Meanwhile, global mining production remains effectively stagnant. The equation is brutally simple. Industrial necessity is accelerating, and supply cannot keep pace. The market needs over 3,600 metric tons of silver that it simply cannot produce, regardless of how high Shanghai raises its margins. So, what comes next? In the short term, expect extreme volatility, more emergency margin increases, and likely trade halts. Know this: every intervention is a panicked admission of weakness and a loss of control by the institutional players. In the medium term, we will see a continuous widening of physical premiums, the gap between the paper price and the actual price of a bar in your hand, and increased delivery issues at the exchanges if contract holders demand the physical metal. In the long term, the trajectory is clear. Prices must rise into unknown territory, $75, $100, and potentially much higher. Basic economics demands that the price must ascend until either industrial demand is destroyed or new supply is incentivized. The panic coming out of Shanghai this weekend is absolute proof that the market is structurally broken. Authorities cannot stop this revaluation. Industrial demand is relentless. The deficit is structural, and the final law of the market is this: you cannot fight physics with paper. The physical reality of supply and demand is finally crushing decades of paper market suppression.